Hi, everyone, and welcome to UBS Trending. I'm Anthony Pastore. As the second half of the year begins, we continue to wonder if the market performance we've seen in the first half will continue, or have we perhaps reached something like an inflection point? Joining us now to discuss this is Eddie Gabor. He is the co-founder of Key Advisors Group and a frequent guest here on UBS Trending. Eddie, great to see you. Thanks for joining us today.
Thank you. It's my pleasure.
Yeah, sure thing, Eddie. I've got a lot to talk about with you today, but most importantly, let's talk about market performance. Certainly, it's been a pretty wild ride for the first 6 months of 2022. We saw equity markets experiencing the worst first half of a year since 1970, and that equates to a loss of about $8 trillion in market cap in the S&P 500. Here's the question, Eddie. Do you think we're poised for more losses at this point in stocks? Or have we maybe started to turn a corner?
Well, our opinion is, unfortunately, it's going to get worse before it gets better. The next 4 weeks is really going to be about earnings. And I do not have a lot of hope for good earnings. I think you're going to see a lot of revisions down. This inflationary environment we're in is extremely problematic from a consumer perspective. And I think it's going to be really reflected in these earnings reports as they come out. And the other thing too, right, and the 1,000-pound elephant in the room is the Fed. If the Fed is going to continue to tighten during this slowdown, or I believe we're heading into a recession, that's our opinion. If they continue to tighten in that environment, that's just going to make things even worse. So as long as they continue to tighten into this slowdown, and with the earnings expectations that we see coming out here over the next 4 to 6 weeks, which we don't think are going to be very strong, I think the market has more downside before we get that inflection point where we can kind of look and say, all right, now it's time to start nibbling back into the market. Look, we're not going to pick the exact bottom. We know that. But I think right now, patience is key. And let's see what the Fed does this month. And let's see how bad or how good earnings are over these next few weeks.
Yeah, it is interesting, Eddie. We're going to be watching the same thing from our side. And, of course, we'll be looking at the guidance that comes out from all of these major corporations that are going to be reporting their earnings. But you did mention recession. We can't really have a market update without mentioning the R word. Talk is continuing. You mentioned it. We expect it. Bloomberg even did a recent survey showing one of their reads that there's a 38% chance of a recession in early 2023. Probably wouldn't surprise a lot of folks listening to this conversation. But there are some Wall Street strategists that I've been reading some reports, and they're saying investors should brace for a recession shock. And I'm using air quotes for that, recession shock. Recessions are common, but big recessions like we saw in 2008, 2009 are not so much. But what is your expectation? What do you think they mean by a shock here?
So I think one of the biggest things is because the labor market continues to be very strong, there's this false sense of security that things really aren't that bad. And when you hear the word shock, I think where the shock comes in is, and we get calls from investors around the country, and most of them are not positioned for a recession. They think the worst is behind us. They say things like, how much worse could it possibly get? And that's where the shock comes in, and that's where the wealth effect also impacts things negatively. So I don't think the average person truly understands, unfortunately, the backdrop of how bad it actually is from an equity style perspective, because this is a rare instance where the Fed is not here to help us, right? They're not here like in 08, 09 to come and cut rates and inject liquidity. They're doing the opposite of it. So they're pulling that liquidity away. They're tightening things. And that's why the bond market, which I think is giving us a very clear signal when you look at high yield spreads, of how bad it actually is from an equity standpoint. And so that's why my biggest fear is the Fed ignores all the things that we're watching, the recession that we think is happening, these high yield spreads, and just continue to blindly raise rates into that environment. That's very dangerous in our opinion. And I don't think there's many investors that have been investing dollars in that type of environment before.
Absolutely. We talk about the Fed all the time here. The Fed certainly has a big job, and they're trying to see what they can do to, assist the economy. Of course, we don't want to be reaching that. It looks like we may have reached stagflation already when you look at the way that the yields are peaking, especially on the 10-year back on June 14th at around a 3.3. Now it's around a 2.8, but that spread between the 10 and 3-year treasuries is pretty wide. So it really does kind of flash that recession sign. And of course, the Fed is monitoring all that. But with bonds in mind, what do you think this simultaneous decline in treasuries and stocks is actually telling you? How can you look back at history and say, well, this is what that means and this is what we're in for?
Well, this again is why, to your point earlier, this has been one of the toughest markets in well over 40 years, because when you look at bonds, which many times are considered a safe haven, if you own long-term treasuries heading into this year, you've gotten clobbered in the short term because of how big of a jump we saw in the 10-year. So the dynamic with the 10-year, which is very interesting because we track the bond market very closely, is we came in not expecting a lot of rate hikes. And then the Fed started really getting very, very hawkish. And then the bond market started pricing in a lot of rate hikes. And that's where you saw that 10-year really spike. It's going to be interesting to see heading into July if the Fed does come in with another 50 or 75 basis points. If that 10-year bond shoots through that 3% mark, I think we probably have seen the high in the 10-year for the year. That's my opinion. Because we were pricing in a lot of rate hikes that I don't think are going to be able to happen because of this potential recession we're heading into. So hopefully the bond market in the second half of this year will start to calm down from a yield standpoint. But now the yields are coming down because I think it is pricing in a recession and you're getting the inversion of the yield curve. So we've seen two different stories here in 6 months in regards to what's made these interest rates move, in our opinion.
Absolutely, Eddie. And we've got this rapid run up in borrowing costs. You've got tightening financial conditions, and as we keep talking about, decades high inflation, and maybe the Fed, in this attempt to cool the economy, is maybe tipping the U.S. into recession. That's certainly some opinion out there. So given all of that and where we sit today as we get into the second half of the year, where do you find opportunity for investors right now? I know you're a fan of small caps. Do you still think there's space, room in that space for investors right now?
So right now, we are taking a very cautious approach for our clients. And what we've told them is we're going to wait and see what these next 4 weeks, because these next 4 weeks, you're going to get a lot of information from the Fed as well as from earnings. So we do think we're going to have some amazing buying opportunities, but we don't think it's going to come till late third quarter, early fourth quarter, because we think that's going to simultaneously come with the Fed not pivoting from the sense of starting to cut rates, but sending signals that they're going to start tightening not as fast and maybe not as aggressive, and maybe just do nothing. I think that's going to be the next thing that they do, because this economic data, if it continues to deteriorate at the rate that we're seeing it deteriorate, I find it hard to believe that the Fed's just going to continue to raise 50 and 75 basis points. So I think if you're patient, you're going to get a much better entry point in the small cap sector, mega cap tech sector as well too. These areas that have really taken a beating. But again, we think there's more pain to come here in the near term, so we're just going to wait.
Eddie, thank you so much. It certainly is a tough market, but great to get your insights, and always good to see you, sir. Thanks for joining us.
Thank you for having me today.
Great, you too. Eddie Gabor, again, co-founder of Key Advisors Group. And for more information on anything we spoke about today, plus some of the views from our own Chief Investment Office on the markets that are happening out there right now, visit our website at ubs.com/views, and make sure to follow UBS on social media, LinkedIn, Facebook, Instagram, Twitter. Plus, you can check out all of our past UBS Trending episodes on demand, all the information right there on your screen. And as always, if you have any questions about your own portfolio, especially given these volatile market conditions, make sure to reach out to your financial advisor. Until next time, I'm Anthony Pastore. Have a great day, everyone, and remember to keep your eyes on what's trending. We'll see you soon.